Okay, class. I have an example problem that I'm going to do for you now relating to adjusting entries and how they affect the financial statements. This was one of the questions that the forums had asked for. So I found this problem. It's from a older textbook, but it will apply to whatever you're working on now. And let me go over this with you real quick. Okay, so it says, this company is called Ashton Air Purification System, and they give me the trial balance, which is here. Now this is an unadjusted trial balance, meaning that these balances don't reflect any adjustments or any adjusting entries yet. Okay, and what we're tasked with doing is we're tasked with preparing the adjusting entries, then coming up with new balances. So what we do is we take the effect of the adjusting entries and we factor that effect in on the unadjusted balances, and we'll come up with new balances. Okay, so if you were doing this in a spreadsheet, you'd probably have these unadjusted balances here, and then to the right of that you'd have the adjustments, and then you'd have the adjusted balance, okay, which would show the effect of those adjustments. Okay, it would reflect the effect of those adjustments. Okay, so let's see. Let's start with the adjusting entry. So it says journalize the adjusting entries on December 31st. So it says, on December 15, Ashton contracted to perform services for a client receiving $3,000 in advance. Ashton recorded this receipt of cash as unearned revenue. As of December 31st, Ashton has completed $1,500 worth of those services. Okay, so what it's saying is, if you look at your unearned revenue account here, there's a $3,000 balance sitting in there. That's a $3,000 liability. That was money that they received in advance to do services. But at that point in time, December 15th, they hadn't performed those services yet. Now what this is telling me is that they actually performed $1,500 worth of those services between December 15th and December 31st. Okay, so on December 31st, what we have to do is we have to, notice, unearned revenue has a credit balance. We have to take $1,500 out of unearned revenue. So we'll do that by debiting unearned revenue. Okay, and now that it's no longer unearned revenue, it actually is service revenue. So we're going to credit service revenue 1,500. Okay, and that's an adjusting entry. Now, this is an unearned revenue is an example of a deferred revenue account. Okay, so this deferred revenue is a liability. It's sitting over here with the other liabilities. And the reason we call it deferred revenue is because we're deferring the recognition of revenue until it's actually earned. So revenue is earned when the services are performed or the goods are delivered, depending on what kind of business you're in. Okay, so in this case, because they provided the services, they earn the revenue, so it's no longer deferred. Now it's really revenue. It's service revenue. Okay, to record service revenue that was collected in advance. Okay, that's the best option. Okay, now the next scenario says, okay, Ashton prepaid 2 months of rent on December 1st. So if they prepaid 2 months of rent on December 1st, and 1 month has gone by because now we're at December 31st, the date that we need to make these financial statements, okay, 1 month has gone by. Let's see. What's sitting in prepaid rent? $2,200. So if $2,200 is 2 months worth of rent, okay, you could take $2,200. This is really simple, and divide by 2, and you come up with $1,100. That's 1 month's worth of rent. Okay, so you have this asset called prepaid rent sitting there, $2,200, which represents 2 months worth of rent expense paid in advance. Okay, so because you haven't really received the benefit of that rent payment on December 1st, okay, you don't really receive the benefit of the rent payment until time goes by, okay? So since the time that rent applies to hasn't gone by yet, you don't call it rent expense. You leave it there in an asset called prepaid rent. And by the way, that's what we call a deferred expense. So that asset, prepaid rent, is a deferred expense. It's an amount sitting there waiting to be turned into an expense. Okay, so as the months go by, you'll move it out of prepaid rent and put it into rent expense. Okay, so since we're making financial statements on December 31st, we have to make 1 month's adjustment, because 1 month has gone by from December 1st to December 31st. So what we're going to do is we're going to take 1,100, which is 1 month's worth of rent, and take it out of prepaid rent, which is an asset. So notice the asset has a debit balance, but as we decrease the asset, we credit that asset account. Okay, and then expenses increase with debits. So we're moving it out of prepaid rent into rent expense. Okay, so this is to record rent expense. Okay, let me rewind a little bit. Also, notice that as every adjusting entry has both a balance sheet and an income statement effect. Okay, so take entry, the first entry, A here, right? See that unearned revenue is a liability. That's on the balance sheet. Service revenue is revenue, so that's on the income statement. So all of these adjusting entries are going to have an effect both on the balance sheet and the income statement. Take our second one, entry B. Rent expense is on the income statement, and prepaid rent is an asset on the balance sheet. Okay, let's hit check answer, and we did okay. Fantastic. Okay. Now, office supplies is another example of a deferred expense. When we buy these office supplies, we stick them into an asset account called office supplies. Okay. Now, as we use the office supplies up, we take them out of the asset account and we turn them into an office supply expense. Okay. So the whole idea is that we want to match the expense with the revenue that it helped to generate. Okay, and if we had booked all of the office supply costs straight to office supply expense, all of that expense would have occurred in one period, and we may not have used those office supplies until another year, right, in the future. So what we're trying to do is match the expense against the revenue that it generates. Okay, so office supplies are fairly easy to take care of. They said that we used up $550 worth of office supplies. Well, come over here. Let's look. See, your office supply expense account is sitting at $1,200. So we're going to reduce that office supply expense account by, office supply, the asset account, we're going to reduce it by $550. So in order to do that, since it's sitting here with a debit balance where my mouse is, 1,200, we're going to have to credit that account to reduce it. So I'm kind of doing this backwards, but office supplies will be credited 5,500, and that amount's going to turn into supplies expense. See how that works? Okay. And again, you have an income statement account, supplies expense, and you have a balance sheet account, which is an asset, office supplies. And that's to record the office supplies used. Okay. Depreciation, another example. I think the book makes that a separate category of its own. So you can keep those 5 categories, but in my email to everyone, I told you there's 4 types of adjusting entries, right? Accrued revenue, accrued expense, one's related to deferred revenue, and one's related to deferred expense. Well, depreciation expense depreciation, the entry is an adjustment to a deferred expense. Now with depreciation, what we do is we're going to have a depreciation expense account, but we're not going to reduce the equipment directly. Okay, so unlike office supplies, unlike prepaid rent, we don't credit equipment directly. What we do is we have what we call a contra asset account. So everybody should remember that. This accumulated depreciation is a contra asset account. And the way that works is it sits over here on the, it'll sit on your balance sheet. So you'd have an equipment account, and then right next to it in the asset section, you'd have the contra asset account called accumulated depreciation. Okay, and that would be, it would be subtracted. So you'd always show your equipment at its cost minus its accumulated depreciation. I'll come back to that after we make this entry, okay? So we don't have to calculate the depreciation in this example. In a future chapter, you would have to actually come up with the $700, but they're giving it to you. So what I'm going to do is I'm going to increase the depreciation expense with a debit, and I'm actually increasing a contra asset account called accumulated depreciation, which has a reducing effect on the equipment, okay, by 700. So we got, okay, so we got a expense, which is on the income statement, depreciation expense, and then we got accumulated depreciation, which is a contra asset on the balance sheet. Okay, we hit that, and we're okay. Good. Okay, now let's see. Okay. I'm going to take a little quick aside here. Let's focus on this. Now, see, this accumulated depreciation on your balance sheet in the unadjusted trial balance is $4,000. After we make this entry, see, it's a $700 increase. It's going to be $4,700. Okay. See, the equipment's cost is $19,500. So if I were going to show that on my balance sheet, let me just set you guys up here. Oops. If we wanted to show that on the balance sheet, you'd show your equipment at its cost, always shown at its cost, and then you'd show the 4,700. Remember, 700 was, it was increased by 700. Okay, so your net equipment would be the difference between, right? That's how it would appear on the balance sheet. Okay, net of its cost. Okay, so cost minus accumulated depreciation. Okay, remember, accumulated depreciation is a contra asset account. Now let's see. Adjusting entry E. Ashton received the bill for December's online advertising, $800. Ashton will not pay the bill until January, and it's telling me to use accounts payable. So what we're doing now is this is an accrued expense, really. And you got a bill for an expense for advertising. So now you got advertising expense. That's an income statement account. I increase it by $800 by using a debit. Okay. And then they don't want me to use a specific advertising payable. They said just put it into accounts payable. So now we have a liability, right? So this company owes $800 for its advertising expense. It's still expensed in this year, in 2014, but it won't be paid until 2015. So it's going to appear on the 2014 income statement as an expense, and on the balance sheet as a liability called accounts payable. Okay, so no cash was spent yet. The cash will come out of Ashton's account in 2015. Okay, so this is to accrue advertising expense. So accrue has that feeling of capturing more. You're accruing, right? You're getting those expenses onto your income statement, and you're reflecting what you owe as a liability. Okay. Okay, and then now let's see. If Ashton pays its employees on Monday for the previous week's wages, its employees earn $5,500 for a 5-day work week. December 31st falls on a Wednesday. Okay, so we have a little bit of math to do here. If you think about it, they're getting paid for a 5-day work week, which is $5,500. So in total, we'll scroll that up. If you took $5,500 and divided by a 5-day work week, you should get $1,100 per day. Okay, so they're paying for the last 5 days on a Monday. Okay, so it sounds like they're paying weekly. Now, December 31st falls on a Wednesday. That means that they haven't been paid for 3 days, right? If you think about it, Monday, Tuesday, and Wednesday. End of business Wednesday, December 31st. So that equals 3 days at $1,100 per day. And that should give me $3,300. Okay. I'll just put it right in there for you. So what we need to do is we need to make an entry to accrue the salary and wages expense for $3,300. Okay. We did the math here. I'll get this out of the way. So we'll put the numbers in. 3,300. 3,300. Okay. And the accounts that we have to choose from, we got salaries expense. So we'll go salaries expense. That's on the income statement. That's an expense. And here's your balance sheet account called salaries payable, because they're not going to pay it till the following Monday, right? It's being accrued for the work done on Monday, Tuesday, and Wednesday up through December 31st, which is the financial statement date. This $3,300 payment will be part of the $5,500 payment that happens on the following Monday. Okay, so that would probably be, if Wednesday is December 31st, right? Thursday would be January 1st, right? Thursday. Friday would be the 2nd. Saturday, the 3rd. Sunday, the 4th. Monday would be the 5th. So they would get their $5,500 payment on the 5th, which is Monday, but 3 days of that relate to 2014. Okay, everything up through Wednesday. Okay, so we're going to say this is to accrue salaries expense. Okay, so you kind of got to figure that out when you do that. Where does the year end or the period end? It could end in the middle of a week. It could end in the middle of a pay period. And you have to make sure you get those days that pertain to the year that you're working on. So in this case, it's 2014. You got to get those days captured into the correct year. That's the whole purpose of this adjusting process, is to get the amounts into the proper year. Okay. Okay, let's see. Now down here it says, on October 1st, Ashton agreed to provide a 4-month air systems check beginning October 1st for a customer for $3,600. Ashton has completed the system check every month, but payment has not yet been received and no entries have been made. So what's happening is, this is kind of the opposite of unearned revenue. This is actually an accrued revenue. Okay, what it's saying is, we did the work. Ashton did the work. So they actually earned $3,600. They did the work, but they haven't been paid yet. Okay. So what we have to do is we have to record it as revenue. Remember, revenue is recorded when it's earned, whether you received it or not. Okay, so I'm going to kind of do it in reverse. I'm going to record the revenue first. So this will be service revenue. And I'm going to book it as a credit to service revenue, because service revenues increase with credits. But because we haven't received it yet, we cannot put it into the cash account. So we're going to use another asset called accounts receivable, which is on the balance sheet. Okay, 3,600. And this is to accrue service revenue. Okay, so we've gone over, oops, let's see, did I make a mistake here? On October 1st, Ashton agreed to provide a 4-month air system check beginning October 1 for customer. Okay, you know what we overlooked, and it's great that we made this mistake. 3,600 is for 4 months. Okay, if you go back and you look, and that's why it's important to pay real close attention. October through December 31st, all of October, November, and December, that's only 3 months. So really, we shouldn't be using the full 4-month figure. We should only be calculating 3 months worth. Okay, so we could do this. We could say 3,600 divided by 4 months, because the 3,600 is for 4 months, will give me, should be 900 a month, right? Let's see. I'll just do it for you so you're sure. 900 a month. And then you would multiply it by 3 months, because only 3 months have gone by. So we say times 3 months. Okay. So if you multiply that by 3 months, which is, let me spell it out, October, November, and December. Oops. Right? Make it a little bit bigger for you. Okay. So if you do multiply it by 3 months, what you're going to end up with is 2,700. Oops. Just do it like that, times 3. Okay. So that's the amount that we have to use. We're not going to use the full 3,600. We're going to use 2,700. That's 3 months worth of revenue that's been earned. Okay, so there's still another 900 sitting in your, or another 900 of revenue to be earned, because they have one more month, which would be January 2015. They have one more month of service to provide. Okay. One more month of air check. What does it say? Air systems check, service to provide. Now we're good. We're fantastic. Okay. Now let's see. After you make adjusting entries, right, you're going to post them to your ledger accounts. Okay. So you're going to go from your journal entries and you have to post them. So let's just do the first one. I'm going to take my unearned revenue, which has a debit from this journal entry, and service revenue, which has a credit. And I'm going to post those to each of their respective accounts in the general ledger. So unearned revenue, I have to take a $1,500 debit. So where's my unearned revenue account? We'll go 1,500. Okay. And service revenue has a credit from that first entry. Service revenue has a credit of 1,500. So I'll put a $1,500 credit. And I believe they want us to use the letters as references. Okay. Or you could use the date. But that's entry A, December. They're all December 31st because that's when you're going to make these adjusting entries. Okay. So we're going to take entry A and I would label it as a reference. So let's see. Entry A. Okay. And the other one is also labeled entry A. So if someone was looking through this ledger, they could go back and they could trace back to the journal entry, okay, entry A. And they could see everything that happened. So the journal actually gives it to you by transaction. So you get to see the full transaction in the journal. But what we're doing over here in the ledger is we're showing it by account. Okay, so you can see everything that happened in each specific account, along with the balance, which you'll come up with at the end. Okay, so in this example, the computer makes it a little easier because they let you look at what you did in summary. So this is just a reprint of everything that we did up here. So it makes it a little easier to post this. Now the other thing that you also want to make sure of is you want to make sure that your ledger shows your unadjusted balances to start. So I'm going to just kind of scan a couple of them here. See, cash December 31st starts out with a $7,400 debit balance. That's agreeing with what's on that unadjusted trial balance. Okay, that's the same with accounts receivable, 19,800. So I'm fairly confident that I don't have to go through and make sure that what we call the beginning balances are in every account. Okay, it looks like the beginning balances are there. So really my task now is to post these entries. Okay, so entry B is a debit to rent expense of 1,100. Put entry B in there. And a credit to prepaid rent. Okay, make sure when you're pulling them over, you're putting them on the correct side, debit or credit. Remember, debit is left and credit is right. Okay, so that's entry B. Okay. And then entry C is a debit to supplies expense. So let's see, we might be able to inch this up so they're all somewhat visible. Well, maybe not. Okay. Supplies expense gets a debit of 5,500. I'm on this one right here, entry C. And it says office supplies gets a credit of 550. I'm sorry. That's what it is, 550. Office supplies. That's entry C. Okay, entry D. Depreciation expense of 700. That's a debit. And accumulated depreciation gets credited by 700, entry D, and that's a credit. Okay, so that's actually increasing the accumulated depreciation. Let's see, entry E, advertising expense 800. So there's a debit of 800 to advertising expense, entry E. And accounts payable gets a credit of 800. Okay. So you can imagine, right now people might be saying, well, I could easily figure the balances out from the journal entries over here on the right. I don't need to make this ledger. But imagine thousands and thousands of entries, right? The ledger actually is a better tool for tallying up what you have in each account. Okay. Now let's see. Entry F, salaries expense is debited for 3,300. Okay, that's entry F. And salaries payable is credited for 3,300. So let's find salaries. 3,300. Entry F. Okay. Then we got one more. Entry G, accounts receivable gets a debit of 2,700. That's entry G. And service revenue gets a credit of 2,700. So I'm really just taking, just like we did in chapters 1 and 2, when you learn debits and credits, we basically are taking the amounts from the journal and posting them to the ledger. So once we do that, we're able to come up with balances in each account. So the way we come up with balances is, I'm going to put the journal away real quick. Okay. We go down in each account, we look at the total debits and we look at the total credits, and we get the difference between the two. And the side of the account that has more on it is where we put that difference. Okay, so in this case, cash, no problem. It's there's only one thing in there, so I'm just going to bring the balance down. And since it's a debit sitting there, I bring it down as a debit balance. Okay, 7,400. Now let's look over here at accounts payable. Okay, there's really just two credits sitting there. Okay, so all I have to do is combine the two credits. So 3,500 plus 800 would be 4,300. That's the new balance. Does everybody see that? Okay, so you kind of think about that. You should know how to do this already, but this is kind of a comprehensive problem, so I'm going to show this to you. Okay, so if you have any confusion. And you know, I think in your My Accounting Lab, you have a calculator here too, so it's easily, you can pull that up. So service revenue, we got three things we got to combine. The unadjusted balance of 15,300 plus adjusting entry A, the effect 1,500 plus the effect of adjusting entry G, 2,700. So you have a new balance of 19,500. Okay. And we'll do every account. Accounts receivable, you got a debit of 19,800 to start. Then there's another debit of 2,700. Okay, so you got 22,500 balance. Salaries payable, no brainer, just bring it down. There's no additional entry beyond what the original unadjusted balance was, 3,300. Okay, salaries expense, pretty easy, right? You're going to have 6,700, right? You're just adding the beginning balance and any adjustment. Now we get into things that are actually going to, the balances are actually going to get reduced a little. So let's see. Let's roll it up here. We got prepaid rent. Started with 2,200. Then it got credited 1,100. So what happens is you're going to take the 2,200 and subtract the 1,100. So you're really left, since you still have more debit than credit, you're left with a $1,100 debit balance. Okay. Now let's look at unearned revenue. See, unearned revenue is a liability. It has a normal credit balance. So it started with 3,000, right? And then it got debited for 1,500. So 3,000 minus 1,500 leaves you with 1,500. That's the balance. Rent expense, no problem. 1,100. Okay. Let's see. Office supplies is a good one to look at. You started with 1,200 and you have a credit of 550, so you subtract 550. So you're left with 650. See? And I put it in on the side where there's more, right? There's still more after, you know, there's still more on the debit side than on the credit side, so the difference is going to end up on the debit side. Okay. Common stock did not change. You just need to bring the balance down. Depreciation expense actually went up by 700. See, there's no beginning balance in depreciation expense. So D is an adjusting entry. It actually increased depreciation expense. Equipment stayed the same. Dividends, no change. Okay, look, advertising expense started with a balance of 1,500. You added another 800, so that's a 4,300. Oops. Accumulated depreciation started, and this is the one that I did over here in the spreadsheet for you earlier. See? 4,700, right? It had a beginning balance of 4,000, and then another 700, and depreciation expense was recorded, so that actually increases your accumulated depreciation. to 4,700. Supplies expense, no. No other entry aside from adjusting entry C. Okay, so we'll scan them over real quick. We may have had a couple input errors. The system will let us know if we're off, but I think our balances look pretty good. We'll check answer. Okay, now when you get an error, take the time to read what it says. One or more of the balances are incorrect. Review the T accounts for any stray postings and remember to leave unused cells blank. Recall the normal balances of each account and check your calculations carefully. Make sure you are entering the balance of each account along with the balance reference on the correct side of each account and try again. So we just need to go back and review. I'll pull this back up. This is kind of the way it is. It's a little tedious because there's a lot of room for human error. You know, it's not complex mistakes that we're making, but we're making little minor mistakes, forgetting to add correctly, possibly. So cash, I believe, looks okay. Accounts payable, let's see. Entry E, that's a credit. That looks okay. 3,500, if you don't really do your mental math too well, then you come back and you plus 800. Make sure that you're adding correctly 4,300 and it says balance, okay? So we can do a quick check. And everybody needs to kind of go through this, making a mistake to learn it. You got to make the mistake and go back and figure out what you did wrong. Let's see. A is 1,500. G is 2,700. Okay. Looks like we did okay on that one. Accounts receivable. Let's see. 19 plus 27 from entry G. 27. Okay. Double check your math. Okay. 22,500. So that's the kind of thing you got to do. You got to go back and check. Sometimes you're able to pinpoint it right off the bat what you did wrong. Other times it takes a little longer. Okay, let's see. Salaries payable, 3,300 from F. Balance is 3,300. Let's see. Salaries expense starts with 34, 3,300 from F. Okay, and if you combine the two, that sure looks like 67 to me, but you might want to go back and trust your. Okay, 67. Going down the list, prepaid rent. There's a $1,100 credit in entry B. That's fine. And then your balance would be the difference, 2,200 minus 1,100. Okay. Unearned revenue, entry A, a debit of 1,500. You're starting with 3,000, so the difference is 1,500 balance. Rent expense, 1,100 from entry B. Balance, 1,100. Just pull it down. Let's see, office supplies. From entry C, there's a $550 credit. Started with 1,200, so if you subtract the two, $650 balance, office supplies. Okay, common stock, 38,500. Nothing affected common stock. Depreciation expense, 700 from entry D, 700. Equipment, 19,500. No effect on equipment. Dividends, 9,300. Okay. Advertising expense, 1,500 started. There it is. Okay. So see the human error. We started with 1,500. We added 800. Okay. It really should be 2,300, we improperly put in a 4. So something as easy as an input error, okay, and I may have said 43. Your brain does funny things, okay, so it really is 2,300, okay, and just eyeball the other two, okay, so we found our mistake, check answer, fixed it, fantastic, okay. So kind of back to the idea of do it once, do it right. It'll save you time if you're really meticulous up front. If you're trying to go quickly, the likelihood of making a mistake is higher. Okay, now, how does it flow into the trial balance? A trial balance, because our accounting equation is a mathematical thing, you know, we're in balance. Assets have to equal liabilities plus equity. That same logic plays into the fact that we should have a total debit amount in all of our accounts that's equal to the total credit amount in all of our accounts. So that means that we're going to take all of our account balances from the ledger and we're going to put them into a thing that we can test this with called a trial balance. But in this case, it's going to be an adjusted trial balance because the adjusting entries have been considered in the balance of each account, right? Notice, take accounts payable, for instance, right? There's an adjusting entry E that affected accounts payable. Well, when we come up with the new balance of 4,300, that's taking that adjusting entry into consideration. So if we were to use the unadjusted trial balance, what you're first given, these balances, although they're the total debits and total credits equal, these balances do not take the effect of the adjustments into consideration. So we're going to prepare a new adjusted trial balance, a new trial balance called an adjusted trial balance, which takes the effect of these adjusting entries into consideration. So our task here is to take the balance from each of these accounts and pull them up into another working paper called a adjusted trial balance and show all the accounts debit balances and all the accounts credit balances. Just the balances, not all the activity in each account. So again, just like with the other example, okay, we're able to re-show what we already did here. So we have this handy. Now all we really have to do is bring those balances over. And again, here's a chance for human error because I come over here, I see I have a debit balance in my cash account, 7,400. If I'm moving really quickly, I could make the accident of putting it into the credit column by accident when it really belongs in the debit column. So you just have to be careful. Let's see if we can get it right with no error this time. Cash debit balance, 7,400. I think we're going to go this way now because the accounts are listed assets first. And I notice in our ledger, assets are running down this column. So I'm going to work this way. Accounts receivable, 22,500. Prepaid rent, 1,100. Office supplies, 650. Equipment, 19,500. Now remember, because accumulated depreciation is a contra asset account, it has a credit balance, even though it's sitting here with the assets. So be careful, because see, it's sitting on the right side, the credit side, 4,700. Okay, I'm just pulling it from here. Now we can scroll up. The next thing we have is accounts payable. Now we got credit balances, 4,300. We got salaries payable, 3,300. Unearned revenue, a liability, 1,500. Common stock, now we're into equity. Credit balance, 38,500. Okay, now dividends. Remember, dividends have normal debit balances because they decrease equity. So 9,300 to dividends. Service revenue swings back to the credit side now, 19,500. I'm just pulling it from the ledger. Salaries expense, debit of 6,700. Rent expense, debit of 1,100. Depreciation expense, debit 700. Advertising expense, debit 2,300. And supplies expense, debit 5,500. So if you're pretty confident in the fact, or pretty confident that you brought these over to the correct side, to the debit or credit side, then what you want to do is, because it's called a trial balance, we're going to test it. We're going to make sure that the total of our debits equal the total of our credits. So this just requires a little bit of math. Maybe some of you can do it in your head real quick, but I'm going to use my calculator. I'll add up the debit column first. So I'm just adding and trying to talk at the same time. Okay, so let's see if I can get it right. Okay. And it should, okay, 71,800, total of my debits. First pass at it, okay. If the two don't equal, the first thing I would do is go back and try to re-add it again, because I might have made a mathematical error. If I still can't get the two to balance, then I have to go back and work backwards, right? Make sure I posted the correct amounts to each account. Okay, now I'm going to add up the credit column. And I'm adding up the credit column. It looks like we got the same number, 71,800. Okay, so since I'm in balance, I'm going to hit check answer. And it says nice work. Okay, so we have an adjusted trial balance. Now all of these balances have the effect of our adjustments in there. Because we're doing accrual accounting, we have to make sure that our expenses are recorded when they're incurred and our revenues are recorded when they're earned. So by doing entries A through, A through G, we've assured this. We've made sure that we've recorded all the revenue that we earned and recorded all of the expenses that we incurred. Okay, and adjusted the accounts accordingly. Okay. So now, before I answer this conceptual question number 4 down here, what I'm going to do is, the forum question was, show me how this ties into the financial statements. Okay, so what we can do is we can take our adjusted trial balance, and the first thing we can do is we can prepare, let's get this straight. We're going to prepare ourselves a first financial statement you prepare is a income statement. So you would head it up, Ashton Air Purification System. We would call it income statement. And I like to give the full, so it's for the year ended December 31st, 2014. Okay? And we'll kind of head it up like that. Right? Center it across the top. And then what we would do is we would take the amounts from our adjusted trial balance that pertain to the income statement. So remember, revenues are on the income statement. So right here we got service revenue. And we would pull that over, and my service revenue is 19,500. And then we got expenses. And we have several, so I'll list them. We got salaries. We got rent. And I'm just pulling it from the trial balance over here. So if you set your trial balance up, you list your accounts by category. So assets, liabilities, equity, revenues, and expenses. Then it's easy because you can just look over to that section and pull the things over to your financial statements that you need. So I got rent. Let's see, we got depreciation. So I'll just put it in. depreciation, equipment, advertising expense, and since I'm heading it up with expenses here, I don't need to say expense on every one of these, okay? And then I finally have supplies. Okay, and then we would have a total expenses amount. Okay, so you might give yourself a little more room so you have space to list the expenses. And then I just bring the numbers over. I got salaries, I got rent, I got depreciation, I got advertising, I got supplies. Okay, so I'll put my total here. So I'll just add them up. And the sum of my expenses equals 11,350, right? So if we were to subtract our total expenses from our revenue, that, because it's going to be positive, it would be called net income. So this is my income statement. It's a simplified version, but revenue minus expenses gives me net income. So we have net income of 8,150. Okay. So you always prepare the income statement first. Okay. And then the next financial statement that would be prepared would be the retained earnings statement. So kind of headed up really similar, but I'm going to say statement of retained earnings. Okay. And this one is also for a time frame. So we say for the year ended December 31st. See, I got the year wrong. We're actually in 2015. No, we're in 14. I'm sorry, 2014. Okay. So what you generally start with is you start with your beginning retained earnings. Okay. So you would go retained earnings, and if you think about it, the beginning retained earnings is last year's ending retained earnings. Okay, so from December 31st, 2013, those are actually the beginning retained earnings for 2014. Okay, so we'll undo that. We'll get this where we have enough space. Okay. So it looks like the company didn't have anything to start. It's probably a brand new company. And then what we do is we add net income from the income statement. So right over here, 8,150. Now, you may have had beginning retained earnings, but in this case, we don't. So it really ends up being 0 plus your net income. And then what you do is you subtract dividends. See, dividends are not an expense. They don't show up on the income statement. So I'm going to subtract the dividends. And if I look at my trial balance over here, my dividends are 9,300. And you could show them as a negative. The word less already indicates that you're subtracting. But just so you guys can see that, I'll do that. Then you're going to end up with your ending retained earnings balance. So that's going to be retained earnings December 31st, 2014. Okay, so that's that subtotal, 8,150 minus 9,300. Okay. Now what we do have now, since it's negative, it looks like it's a retained deficit. All right. Okay, now finally, the third financial statement that we would prepare, and I'll inch over here, would be called the would be the balance sheet. Okay, so this is the balance sheet. That's where we're going to show all of our assets, liabilities, and equity items on the specific date of December 31st, 2014. So that's why it's dated differently. We're going to say as of. So it's not for a time frame. It's as of a specific date. So you would list your assets. We're going to do it in real rudimentary form. We're not going to categorize them yet. We'll start and see if you set your trial balance up in an orderly format, you can just go down the list. So we got cash, we got accounts, and I'll just abbreviate AR for accounts receivable. I'll spell it out for you. You got prepaid rent, you got office supplies, you got equipment, less accumulated depreciation. You got, then you're going to move over, you're going to have liabilities. Okay. So what we would do is we'd have a total assets, and then you'd have your liabilities. And what are your liabilities? You have accounts payable, you have salaries payable. Oops, went a little too fast. You have unearned revenue. So you have another little subtotal here called total liabilities. Okay, and then you would have, it's called stockholders equity. And in stockholders equity, you would have two things: common stock and retained earnings. Okay, then you would have total stockholders equity, and then the big total would be the combination of total stockholders equity right, total liabilities and total stockholders equity. So you would combine this total and this total, and that should agree with what your assets are. So let's see if we can get to that. I'm going to start with my asset amounts. So I got cash. I'm just pulling from over here on the trial balance, 7,400. Accounts receivable, prepaid rent, office supplies. I got equipment. Now make sure your accumulated depreciation goes in as a negative, 4,700. Okay. And then what we'll do is, maybe don't even need that column there. We'll tally those up. Then we'll do our liabilities. We got accounts payable, see over here, 4,300. We kind of go down, we got salaries payable, 3,300. Unearned revenue, 1,500. So you could get a quick subtotal of your total liabilities. Let me put a little. And then you'll do your common stock, which is 38,500. Retained earnings. Now this is where you have to tie it into the previous previous financial statement. That's why we have to prepare them in order. So we always do income statement first, retained earnings statement, and balance sheet. So in this case, we have a retained deficit, 1,150. So we'll bring that over as a negative, and then we'll combine the two. Okay. And I probably would kind of label my retained earnings statement this way, just in case there is a deficit. All right. Now let's see. We have to combine our liabilities and equity. So I'm going to add my total liabilities and my total equity, right? And it should match my total assets. That's why it's called a balance sheet. And in this case, it looks like we check out pretty well. Okay. So our total assets equal our total liabilities. Okay. So that's the way it flows into the financial statements. And this is something that is forever. You don't ever change this method. It always works this way. Income statement, retained earnings statement, balance sheet, in that order, using the adjusted trial balance. Okay. So you can review this video if you want to come back to this. Now let's go back over here and take care of that conceptual question, which you should have the answer for now, since you saw what I did. It says, how will Ashton air pollution system use the adjusted trial balance? And it would be to prepare its financial statements, which we just did. Answer. Okay. All right. Thank you. If you have any questions,